A very good afternoon to everyone. As we all know that financial reporting is an important tool in the hands of an entity. It contains vital information about an entity's health. Financial reports are used by stakeholders to track performance of an organization and also for taking the informed decisions. With this, I would like to welcome all the participants in today's session of webinar on excellence in financial reporting, lessons learned, best practices, and commonly found error, specifically in manufacturing sector. We have amongst us the presence of Dynamic Chairman of the Research Committee of ICAI, CA Dr. Anuj Goel, and Vice Chairman Research Committee, CA Kotha S. Srinivas sir. Before going forward, I would like to share a brief introduction about CA Kotha S. Srinivas sir, Vice Chairman Research Committee. CA Kotha S. Srinivas sir is a graduate from Bangalore University and a fellow member of the Institute of Chartered Accountants of India and Institute of Cost and Work Accountants of India. He has served the institute for over 2 decades in various capacities. As a member of SIIRC, he has brought in many initiatives, which includes conducting annual regional residential course, in developing a digital project for SIRC, improvised IVR system for member and students, etc. Now, I would like to request CA Kotha S. Srinivasa to please address the participants.
Thank you. Thank you, Neha. Good afternoon and welcome to each and every one of you, all the participants, the chairman of research committee, Anuj Kumar Goel sir, the speakers of the day, CA Ankit Maheshwari and CA Kuldeep Kothari. Welcome to each and every one of you for this particular program. Today we have a webinar on excellence in financial reporting. So first of all, greetings from the research committee of ICA. I once again welcome all my professional colleagues in the webinar on excellence in financial reporting, lessons learned, best practices and commonly found errors. Today, we keep listening to various news items where the reporting is not proper, auditing has not been done properly, certification has not been done properly. So there will be a lot of regulators will be seeing us. So it's very, very important to know how to do this financial reporting as such. Then ICA has risen to various heights. In fact, ICA is getting into its 75th year of its existence. ICA was started, or foundation day is on 1st of July 1949. On 1st of July 2023, it's entering its 75th year of its existence. ICA has earned distinction as a prominent accounting body, not just in India, but also internationally. So all these years we have been working for India as such. Now, I think after last year, when we did this walkout, we understand or we came to know our strengths that we can be serving the entire globe as such. Research committee of the institute is one of the oldest committee. It has taken various initiatives in the field of research and development of accounting and other affiliated areas for the development of profession. Friends, the purpose of today's webinar is to enlighten the professionals about significance of good reporting practices, including financial as well as non-financial and common errors that organizations make while reporting. Financial statement analysis provides the insights of the organization and assists internal as well as external stakeholders in making informed decisions regarding investment. Today's session of the series of webinar would basically cover the manufacturing sector. So we have been doing, we will be planning to do various seminars, a series of webinars on manufacturing sector. The manufacturing industry, as the name suggests, deals with manufacturing of finished new products from raw materials or essential parts. And one important information that all of us should be aware of, this manufacturing sector accounts for more than 14% of India's GDP, which is the ideal amount for economic growth. So it's not only participates in this GDP in a very, very significant manner, but also it generates revenue to the government and also a lot of employment to the country as such. I would also like to mention that since 1958, as I said, research committee is the oldest committee. It's started in 1958. Through its subcommittees, the Shield panel has made sustained efforts to promote high quality financial reporting through an annual awards competition called the ICA Awards for Excellence in Financial Reporting. So every year we announce for these awards and we give awards, ICA Awards for Excellence in Financial Reporting. Therefore, through this webinar on excellence in financial reporting, the ICA Research Committee aims to build the capacity of all the members and to impart knowledge about the best practices and highlight the common errors that are found in annual reports of various organizations. Now, without taking further time, I'd like to briefly highlight some of the initiatives undertaken by Research Committee. First one, ICA Awards for Excellence in Financial Reporting. As I said earlier, since 1958, this committee is there, and every year we are announcing for ICA Awards. And this year also we have announced for that. The process is open for the financial year 22-23, and last date for nominations is 15th October 2023. Next is ICA International Research Awards. This also we have started recently, the research committee. We are also calling for some research papers across the globe, and we have been issuing the International Research Awards. I think the last year was a huge success with highest number of nominations. That is, we received almost 148 nominations in the International Research Awards, and the selection of the awards is done through a robust two-tier processes involving eminent international jury panel. This year also, this will be the fourth International Research Awards of 2023, and last date of nominations is 30th June 2023. So this is one more initiative. The other initiative is ICA Research Project Scheme. In fact, this year ICA is getting into 75th year of its existence. So we thought, let us encourage our members and request them to do some small, short research project on some 75 topics. So this is one thing which I would like to request and invite all the members to take part in this. It is an open round scheme launched by Research Committee of ICA for the researchers who are keen to undertake research in accounting and other related fields. We are just formulating the scheme as such. We will, within a short time, we will let you know, all the members, whoever is interested to do some work on research on any of the topics, you can do it. The best means which has been selected, we will be even giving award of almost 1 lakh rupees for those particular projects as such. So I want all of you to take part in this. The other one is ICA Doctoral Scholarship Scheme. So if anybody wants to do PhD, the age of that person is less than 40 years, being a member of the institute, then for them also the research committee will provide certain financial assistance for 3 years, for a period of 3 years. It was 50,000 per month. Now we have proposed to 75,000 per month. So 75,000 per month into 3 years, you will get the scholarship. Anybody interested to do PhD or pursue PhD less than 40 years of age, you can definitely contact research committee, and there are certain formalities. If you can just fulfill all those formalities, you will be eligible to do the PhD degree as such. So now I would like to welcome our dynamic speakers of the day, CA Ankit Maheshwari and also CA Kuldeep Kothari once again, who will be sharing the knowledge on the excellence in reporting practices, especially with respect to the manufacturing sector. With these few words, once again, I wish you all happy learning. Thank you, and over to you, Neha.
Thank you so much, sir, for your valuable words. Now, Research Committee ICAI is blessed to work under the able chairmanship of CA Dr. Anuj Goel, sir. CA Dr. Anuj Goel is a practicing chartered accountant and is a Central Council member of the Institute of Chartered Accountants of India. He had made significant contribution to the profession with his extraordinary tenure of 17 years in Central Council, 3 years in Regional Councils, and 6 years in branches, including the chairman of Central Indian Regional Council, chairman of various ICS Central Committees, member of editorial board, and the list is so on. He is a self-motivated, enthusiastic, and hardworking person who has proved to be a great source of motivation, especially for the youth. And his contribution in the field of research and development have always been remarkable. Now, I would request C. Dr. Anuj Goel, sir, to please address the participants.
Thank you very much. Thank you very much, Neha ji. I think the way our secretariat is trying its level best to see that how we can really do something very, very concrete through this research committee for the cause of the profession, for the cause of the nation. I think it is something really great. I welcome CA Kota Srinivas sir, our Honorable Vice Chairperson of this oldest technical committee of the Institute of Chartered Accountants of India Research Committee. we are having the presence of our very, very learned speakers, our very, very good friend, C. Ankit Maheshwari ji from Gulabi Nagri, Jaipur, and of course, C. Kuldeep Kothari ji, our very, very prominent chartered accountant and company secretary and a rank holder from Delhi, and is basically belongs from Rajasthan. When we talk of the excellence in financial reporting, lessons learned, the best practices, and commonly found errors in the manufacturing sector. I think it is our responsibility, rather our religion, to see that how we can really handhold the trade and industry and the chartered accountants to do something really good in the field of the best projected accounts. And friends, the purpose of today's webinar is to enlighten the professionals about significance of good reporting practices, including financial as well as non-financial and common errors that organizations make while reporting. A financial statement analysis provides the insights of the organization and assists internal as well as external stakeholders in making informed decisions regarding investment. The research committee, through its webinar, is here to help the audience improve their understanding of the entity's financial and non-financial insights. The best reporting and disclosure practices while adhering to the statutory norms, rules, guidelines, etc. We are not having the presence of Dr. Amit Agarwal ji, the young and dynamic secretary of the research committee, who is really doing wonders for the cause of the profession through this research committee. Friends, today's session of the series of webinar will basically cover the manufacturing sector. The manufacturing industry, as the name suggests, deals with the manufacturing of finished new products from raw materials or essential parts. It accounts for more than 14% of India's GDP, which is the ideal amount of economic growth. I would like to mention that since 1958, the research committee, through its subcommittee, the SEALD panel, has made sustained efforts to promote high-quality financial reporting through an annual awards competition called ICI Award for Excellence in Financial Reporting, in which entities are recognized for adhering to sound reporting practices. Therefore, through this webinar, the ICI Research Committee aims to build the capacity of all members and to impart knowledge about the best reporting practices and highlight the common errors that are found in annual reports of the various organizations. Friends, a lot of things has already been covered by CA Kota Srinivas, or Honorable Vice Chairperson. I will not take you further time and eagerly waiting to hear. I think first Kuldeep Kothari ji will speak, and then Ankit Maheshwari ji is amongst all of us. I once again welcome all our audience from each and every part of the country and outside country to this initiative of the research committee. Thank you very much.
Thank you, sir, for your valuable words. We have amongst us the eminent speakers who are a great source of knowledge for all of us, C. Ankit Maheshwari and C. Kuldeep Kothari ji. C. Ankit Maheshwari is a highly accomplished and dynamic chartered accountant with an exceptional track record of over 15 years of experience, snapping various geographies, with a strong focus on enhancing financial reporting framework of large listed companies in India. Ankit ji has established himself as an expert in assurance. And CA Kuldeep Kothari is a fellow member of the Institute of Chartered Accountants of India. He has expertise in the field of FR framework, ESG reporting advisory, direct and indirect tax litigations, investment and startup consulting. He is also the author of various books and has delivered lectures on the topics like FRF, income tax, GST, investor awareness, etc. Now, I would like to request CA Kuldeep Kothari and CA Ankit Maheshwari ji to please start with today's session.
Hi Neha, thank you. Thank you so much. I and Kuldeep have been jointly working since many years on this financial reporting framework. And the strategy is that we jointly take a session. So there are certain aspects which Kuldeep covers. There are certain aspects which I cover. But let me put my sincere thanks to, specifically you for seamlessly coordinating and, initiating this. I want to place my thanks to C. Anuj Goyal, the chairman of research committee, as well as the chairman of peer review board. And trust me, he's been constantly traveling since like last 3-4 months because of the mandate of peer review, which is also a part of this entire assurance activity. And it is his dynamism, enthusiasm, the energy level he derives to, put profession in place at first is what inspires everyone here. My thanks to the Vice Chairman Research Committee, Shri C.A. Kotha Srinivasji. It is indeed my first interaction with you, even through a virtual seminar, but I think the achievements of Research Committee, the contribution you have made to the Research Committee is immense. On behalf of Kuldeep and myself, I want to place again a sincere thanks to everyone who have joined this entire series of webinar. And today we are beginning with the manufacturing sector. Lastly, I think this initiative came on table because of definitely efforts of everyone. But I can't miss to thank Dr. Amit Agrawal, who initiated this concept that we will derive this entire series of webinars at a time when the books are closed and people are done with their financial statements and the board meetings are done, and they are in process of preparation of their annual reports. And that is when we feel it is the timing of the entire series is also very relevant. So I don't think he's with you or not, but Neha, please convey my regards to him. Straight away, I think to all the audience, I welcome you again. And let us begin with this entire session on excellence in financial reporting. And I would first place my, share my screen. Neha, you tell me in case, there are any glitches. And any questions which are coming in between, because my request to all the audience and all the members of our institute is that, the virtual seminars are sometimes done with the perspective of gaining a CPR. I think it would be more appropriate if we can have that kind of an interactivity through the chat box and everything. I am very open to all questions. Kuldeep is also open to all questions. And we hope that next one and a half hours are extremely valuable for all of us who are attending this, and gives you much deeper perspective of as to how we can achieve these excellent practices in financial reporting. As rightly said, when we say financial reporting, it is just not about financial reporting. It is about the non-financial part also. As we progress through this session, we will discuss the non-financial parts, in detail, and the financial parts. Primarily, Kuldeep will be taking care of the financial parts. I will be taking care of the non-financial parts. But in case there are any cross questions, we are happy to help you. So friends, when we talk about excellence in financial reporting, the first thing which we should understand is the quality control mechanism as to why, how our institute is regulating the quality control of the assurance services, because I assume that the participants here are from the auditor side also and from the company side also, because both are the interested parties here. So which side of the table you are, that doesn't matter. But what matters is how do we achieve that excellence? To achieve that excellence, we should understand what is the quality control mechanism. Then we understand the regulatory mechanism of the entire financial reporting framework. But very rightly said by Dr. Anuj Goyal and the Vice Chairman himself, that there's a lot of thrust which is given on the quality control mechanism of the institute. And I'll brief you how as a fraternity we are internally monitoring the quality of financial reporting, and how the external factors are there to monitor the quality control mechanism of the financial reporting framework of companies. So with respect to the internal mechanism, we have four very important boards which are formulated by the institute, which monitors the quality control mechanism of our mother institution. If you can use your chat box and can tell me about these boards, I'll be happy to receive your responses on it. I am reiterating it again. We have four very important boards of the Institute of Chartered Accountants of India, which monitors the quality control mechanism of our institute. Can anybody answer me through the chat box? What are those four boards? Because I feel, let us first understand the hierarchy of this entire system, and then go to the commonly found errors and who is eyeing what kind of error. So that should be the objective of the entire session itself. So if Neha, we receive any answers on it, fine. Else, I'll take it forward because we are already time scarce. We have it's like an entire ocean, where we have to dig certain specific things out. I read it,
Sir, no
quality
particular
control
questions
mechanism.
as of now.
Okay, fine. So, I'll answer it. We have four very critical boards. Let us understand the prerogative of these boards, the scope, the how do they operate. So the institute has a quality review board. Unfortunately, I would say in January 2019, when NAFRA came, the National Financial Reporting Authority, the quality review board was eventually governed by the rules of NAFRA. So whatever audits, quality review audits have been done now post 2019 have been done by NAFRA itself, and Institute recently, in a couple of days back, only if you received an email, Institute recently is looking for a technical reviewer for quality review board itself, which eventually will be functioning for NAFRA. The second board is the Financial Reporting and Review Board. That's the board which is most critical for you from your perspective, in the sense that this is the board which looks after the financial disclosures, the non-disclosures, the commonly found mistakes, the non-compliance of the technical standards. And there, this board functions like they pick 8 to 10 companies at one time, starts evaluating their financial disclosures, highlight certain gaps in the financial disclosures, and then eventually, this has the report which FRRB prepares either get back to the company or their auditors, or this report, sometimes if the comments are way adverse, then this moves to the disciplinary directorate of the institute. FRRB was formed in 2002 in 226th council meeting of our institute. And when FRRB was formed, I think nobody would have ever imagined the kind of gravity this entire board has. So, to report certain common mistakes from the auditor side, I would say, and even the management side, there are certain very basic mistakes which we see in FRRB report. So Anuj sir, has been closely, watching these or looking at these FRRB reports and looking at the common irregularities which are being pointed by this FRRB report. And we realize that there are certain basic errors. To name a few, I can tell you, basic errors, most basic things. So we will go on the higher things, the non-disclosure and the disclosure part. But I would tell you, as an MSME, what kind of a disclosure mistakes are done. So, for example, I can tell you with respect to dividend income, right? So FRRB highlighted I am telling you some commonly mistakes which FRRB highlights. So they say that the dividend income was disclosed in cash flow from operating activities. Instead, it should have been disclosed in cash inflows from investing activities. Similarly, a lot has been talked about valuation of inventory, whether the inventory is valued at cost or NRV, whichever is lower. But in most of the cases where companies are using softwares like Tally or the non-integrated ERPs, I must say, they face a challenge of valuing these inventories at weighted average cost method. Basic mistakes like the balance sheets, the profit and loss accounts, the financial statements are uploaded by time digitally. That mistake has been highlighted by Ministry of Corporate Affairs also. And sometimes even in the larger companies, I and Kuldeep ji also witnessed basic terminologies difference. Like we say cash flow statement. When we prepare our financial results, the statement which we issue is a cash flow statement, whereas it is statement of cash flow. So all these minutest mistakes, these are being taken care by FRRB. Now the third board is the peer review board, and again the chairman remains to be the same, Dr. Anuj Goyal. And there has been a constant mandate. I'll go back to the history of peer review board, which I learned from himself only. In 2010, SEBI mandated peer review, and SEBI said that all the companies who are listed are required to appoint auditors who are mandatorily peer reviewed. And unfortunately, in this context also, we see a lot of cases in disciplinary directorate where the auditors were not peer reviewed and they were still auditing for listed entities. So my request to all the participants from the management side also, please check for this peer review mandate because SEBI mandated in 2010. Then institute also have mandated it further in 3 tranches. So as of now, on 1st April 2023, any partner who any practicing unit who is auditing for a listed entity or any practicing unit who has 5 partners or more were supposed to be peer reviewed. This mandate was further shifted to 31st July, but I don't see any extension in it. From next year, you see 4 partners and practicing unit, a practicing unit with 4 partners to be mandatorily covered by peer review, and from the next year, 3 partners. So one thing, friends, I think everybody will be able to sense that the Thrust Institute and the Ministry of Corporate Affairs and this government is giving on the quality side of it. So that is why I feel that this entire topic of excellence in financial reporting can only be achieved when the auditor and the management both consensuously decide that we have to, uplift the practices of the financial reporting practices of our concern. And so you will see this, in this entire chain of peer review, only practicing unit, clearly having a vision and plan of performing an assurance activity will be taking the assurance engagement, and the management will also trust on such kind of an entities for preparing their financial reporting framework or auditing their financial reporting framework, who have robust quality mechanism. Very recently, we have a AQMM model also introduced for practicing unit, which is audit quality maturity model. And when you look at that model, there will be your entire proposition for providing this assurance service will change. One thing you can be sure of, if you are a practicing unit and if you are complying to the AQMM model, the end outcome of preparation of financial reporting will be great if you are able to comply to that AQMM model at a practicing unit. A very quick glimpse of that entire model. It is a 600 marks self-audit questionnaire, which is applicable to a practicing unit, only on thrust on how to improve your audit quality through various initiatives. I will not detail it further because I would want to just give you a brief overview and come straight on the points of annual reports. But it is important and inevitable that we understand these things. The last is the Tax Audit and Quality Review Board. And when we say the Tax Audit and Quality Review Board, again, a month back, Institute again opened up an empanelment for a technical reviewer for Tax Audit and Quality Review Board. This board is overseeing the function of the other regulators like CBDT, like RBI, like SEBI, like Serious Fraud and Investigation Office. So all these audits and quality related to these audits, the functioning of this board administers around the quality problems in this other regulator parts. So this is our internal quality mechanism of our institute, and institute has been constantly working around this internal quality mechanism. With this endeavor, institute is not only looking at the quality mechanism, but also promoting the excellence in financial reporting. And I would want to say, even our vice chairman also briefed you about the excellence in financial reporting award. ICI's research committee, I have been affiliated this committee since a period of last 5-7 years, and came to know about these awards also through this. And ICI have been very proactive in terms of encouraging these companies to prepare good financial reporting practices. So Institute gives this award every year. This time the award happened to be in Varanasi on 20th Jan. and they gave category-wise awards. And today we are discussing the manufacturing category. For the achievement of the institute, I would say we received the highest nominations ever, like 260 nominations from various sectors were received. As rightly highlighted by the vice chairman, it is a 4-year process. Once you prepare your annual report, that annual report is reviewed by a technical reviewer, then further verified by a head technical reviewer. Then eventually there's a field panel, and then finally the presentation needs to be made to the jury. The award is of 4 or 5 categories. You have gold, silver, gold, silver, plat, and some entity which receives 3 times gold award is entitled for a platinum award in the 4th year. Also, as rightly said, the international forums like SAPA, IFAC Institute being a member to IFAC recognize this entire process. So it is actually a very prestigious thing to claim that your company is, following the best practices, the excellent practices, above par practices, and happy to share that institute recognizes such kind of practices. And not since today, it has been since years that institute has been able to do that. But blessed today we are that, there's a large volume of participations. Today also on the webinar, I was told that we have more than 500 registrations and a lot of people looking forward for it. So that is, I think we should compliment to our institute for taking such kind of initiatives, creating that kind of an healthy competition. Now let's look at the external mechanism of the entire financial reporting framework. And here the technical part of our the entire presentation starts, right? As of now, if you have any questions, you may please post in chat box. Please feel very free to, post your thoughts here. So with regard to the external mechanism, we discussed the internal mechanism of the quality review board of FRRB, tax audit and everything, the peer review board. Let us look at the external mechanism and external regulatory, how people are eyeing us. So the first which we would want to cover in this entire session is Securities and Exchange Board of India, where we have the LODR 2015 guidelines, regulations, where we will be detailing these regulations in next few minutes. Also, we have other regulations coming from SEBI, be it insider trading regulation, buyback of securities, ICDR regulations. All these regulations are applicable to all listed entities which are, recognized by any stock exchange in India. Importantly, we should understand the applicable framework of LODR guidelines, what needs to be done, how it needs to be done. So that is one thing which, I'll come up with the next slide. Then we have our Ministry of Corporate Affairs, and with NAFRA coming in 2018, I think Ministry of Corporate Affairs has now direct intervention in financial reporting practices of India. In this session, while we take you to the end, we will try to come up with some 10 to 12 commonly found errors by NAFRA in financial reporting framework of the companies, so that it gives you, I sense, working across various companies, that the problem primarily remains to be same, and sometimes NAFRA issues advisory on certain things also. I hope you are aware about the advisory which NAFRA issued on 29th March 2023 regarding the initial measurement of trade receivable and initial measurement of financial instruments. I will detail that entire advisory as we progress with the session, but stay updated with the advisory which NAFRA is constantly pushing you. They give you those commonly found errors. Besides this institute also giving you these commonly found errors. Naturally, we will look into the commonly found errors in complying to Ind AS, as we have seen a transition in last 10 years. In terms of our profession, I see there is a constant transition, and one of the significant transitions, rather two of the significant transitions, which was applicable to the framework of the financial reporting framework of Indian companies. One was the transition of Companies Act 1956 to Companies Act 2013, and the other is the other is the transition of accounting standards to Ind AS, where we have not adopted those Ind AS, but we have converged to those Ind AS from IFRS in the modified way. So we will discuss all these issues. Then you have the other regulators, be it the income tax department, be it your registrar of companies, the enforcement directorate, and serious fraud and investigation office. So what I sense, the whistleblower in this case is SEBI. Uh, and while SEBI blows a particular kind of a whistle, right? It issues a notice, it issues some kind of a show cause, it sensitizes you a non-compliance. When this non-compliance is sensitized, then the institute, then NAFRA takes that investigation further on that account of parameters. And the worst case scenario is that when other regulatory bodies also starts intervening, be it enforcement directorate, be it SFIO, and you realize that all these three things are related. My point here is, if we can eradicate the problem from the compliance of LODR guidelines itself, or the compliance of accounting standards, or the not able to comply to the accounting standards, then the other regulatory bodies have very limited intervention. So let us try and focus to understand how we can make these compliances with LODR guidelines, how we can comply, how in a better way we can comply to the Ind AS or the generally accepted principles of accounting in India to avoid any kind of regulatory issues. Kuldeep ji, you wanted to add something?
Ankit ji, as you have mentioned about NAFRA, and since we are talking about it has been a very talking point in past few years also. NAFRA is giving on particularly on the Ind AS part related to financial instruments and revenue recognition and other Ind ASs. It is, I think, the time has come for all of us to sensitize ourselves as well as the management and the auditors also, because the kind of errors or the kind of problems that has been pointed out in various reports or various orders of NFRA. I think it is there are two perspectives from which we can look at all these issues or orders. One is that the scope of improvement, the need of enhancement in the reporting practices, or the need of enhancement in the process through which we are completing our auditing also. But the second is this thing is alarming. I guess this thing is alarming because the issues which have been pointed out by the NFRA in the NAFRA in its reports, they have categorized it in two parts. One is high impact and there is low impact, and many issues are such issues where along with you we have taken so many programs and we have discussed with many companies also. People even don't think that they are to be reported. So this is alarming, I guess, and this is alarming, I guess, and all this is the chakra of Mahabharat which is running. All these agencies, it originates from the reporting itself. So we being auditors or chartered accountants seems to be in position of Abhimanyu in many situations, that we enter into the process, but we don't know how to get out of it. So I think this is something which is of the utmost importance. So Ankit ji, you continue with the flow of the presentation.
Okay. Right. So I guess rightly said. Also, I feel that sometimes, while we are discussing with large companies about their disclosure requirements, about the sensitivity of the annual reports, about the sensitivity of the non-financial information which we are presenting in an annual report, an entity feels that we already have an in-house accounting team, we already have the great best of the stat auditors, maybe big fours, maybe the bigger ones, bigger Indian firms, and there could not be any scope of financial disclosure lapses. My point here is that I have, in last 10 years, we both have been closely working around this entire domain, I don't want to name any companies, be big companies, be small companies. The financial disclosure is a problem with majority of the companies, irrespective of the size. Also, sometimes you feel you have been heavily incurring cost on this entire compliance system and system of uh, sometimes the auditors charge heavy fees. Sometimes the in-house team also is overstaffed. All these situations, all the cost which you are incurring for your auditing, accounting, assurance activity, is this entire document of the annual report. If this annual report is free from any material misstatement, is free from any material defects, that is when you are able to justify either your auditor's cost or your in-house accounting team cost. And that should be the thrust of the entire session itself.
Ankit,
We
I want to add one thing in this particular, the kind of errors that we were discussing or we will be discussing in the presentation later on. You've spoken about one common error regarding the terminology which is being used in the financial statement regarding cash flow. And I bet you that more than 50% of the people who are auditing, I don't want to, myself is an auditor. I was not aware of the same for few years, and it has been the blessing of research committee or the your companionship that we have come across so far. But more than 50% of the people don't know that whether it is statement of cash flows or cash flow statement. So you can see, because this is a very tiny issue, but the kind of implications it has both on the companies as well as the auditor is, I think, significant. So it is something which is of utmost importance and to be taken care of by both management and the auditors.
so Kuldeep, adding to what you said, I would say that in last 8 to 10 years, the definition of audit itself has changed. So if you recall, I would want to draw the attentions of participants here. Please recall the definition of audit. Please recall what Kingston Cotton Mills have taught us. And let us go back on the basics of auditing, where there was a primary responsibility of the auditor and there was a secondary responsibility of the auditor. If somebody can tell me what was the primary responsibility of the auditor, would be helpful in this entire situation. Can anybody tell me what was the primary responsibility of the auditor? Please use your chat boxes. I humbly request you to use your chat boxes. What was the primary responsibility of the auditor?
No responses yet, sir.
So we are way behind what we are talking about, the financial reporting excellence, financial reporting. How do we do that? We have to come to the basics, and the basics was that the primary responsibility of auditor was the expression of an opinion, was whether the financial statement presents a true and fair view. And can anybody tell me what was the secondary responsibility? After listening to this, can someone tell me what was the secondary responsibility of the auditor? The secondary responsibility was detection and prevention of fraud. Now, why I have told you this, in last 8-10 years, as Kuldeep was rightly saying, the paradigm shift, the last 8-10 years, the shift is that as an auditor, as a chartered accountant who is in service also, you are expected to detect and prevent frauds in the organization in which you are working. And that is why you see the maximum notices which we receive from SEBI pertains to related party transaction, pertains to corporate governance issues, pertains to improper board reports. We will highlight those points in detail. But why I am saying, so if somebody thinks that the institute disciplinary mechanism or quality mechanism is only activated to the practicing professionals, I will reiterate, if you are a chartered accountant, if you're a professional accountant, because with the revised code of ethics coming from 1st July 2020, you are a professional accountant. And if you're a professional accountant who is in service, there is an applicability of a clause, no CLAR. I hope you are aware about that clause. All those participants who are into corporates or into corporate reporting team of these entities, Can anybody tell me what is this clause? No clar. No clar. Have you heard about it? Before LODR, before the regulation of Ministry of Corporate Affairs, before anything else, I want to hear if we have, Neha, if we have a response pertaining to
No response
anybody
yet,
who has
sir.
answered what is no clar.
No, no response.
Hopefully audience have really joined,
Yes, sir.
right? So no clar is non-compliance of other laws and regulation. This is one of the clause in revised code of ethics, which was, which was revised on 1st July 2020. This clause states if a professional accountant, if a chartered accountant is in service and if he is not able, if the company in which he is working, if his employer is not able to comply to any law or regulation, forget LODR, forget MCA, this is something which you are basically expected to do, is not able to comply to any regulations, then he's expected to report it to those who are charged with governance one. But they went one step ahead. If no response has been received from those who are charged with governance, he is expected to report it to the Institute of Chartered Accountants of India. Now, my point here is that those who are in employment, when you see that SEBI, gives a notice or SEBI slams a penalty, and penalty is on directors or penalty is on the company itself, or penalties is on somebody who is doing this insiders trading, you will realize a time in next 6, 8, 10 months with this clause being applicable, SEBI issuing penalty notices to the CFOs and the key management persons and even the senior persons in the finance and accounts team, saying that this clause, the no clause was applicable, and you have not complied to the no clause in not complying to these kind of guidelines. So my humble request here is that, again, I don't know the category of the audience, but I expect that there would be certain from auditor side also and certain candidates from management side also. So please be very careful with this revised code of conduct. Please be very careful with no clar. Please look into the applicability of no clar, and then you should report it appropriately. There's a lot of pressure on the professionals from the regulator, and there's a lot of pressure on institute itself from the regulator to enforce such kind of things where chartered accountants come out and whether they are in service or practice, and they improve the compliance management of these companies and report it in a timely fashion. So again, I will come back, stick to what this entire session is. But let us talk about the LODR guidelines. When you talk about the LODR guidelines, let us first talk about the quarterly and the ambit of LODR guidelines. So an LODR guideline is definitely, definitely prescribes a way to publish a quarterly and an annual financial result. When we talk about quarterly result, there was a recent advisory on 15th March by NSE. And that advisory talked about uploading of quarterly results and the investor presentations. I hope you are aware of that advisory which NSE has given, because in most of the companies, we find a common mistake. And that mistake is that with the investor presentations, you have the quarterly audited results, quarterly results for 6 months, 9 months, or by the time you have completed the period, and the unaudited results with the management commentary all coming in one format. My question to you is, how do you upload these results embedding into your investors presentation? I am repeating this. If you are embedding the investor presentation with your management commentary and audited results, then it is a wrong way to upload the entire quarterly results. I hope it is clear. Kuldeep ji, if you allow, should I open the advisory of NSE itself?
perfectly fine, sir. I think it would be better for the audience to understand what we are trying to say.
What we're trying to say, right?
Hmm.
Is it visible?
No, sir, it is not visible yet.
Okay, just a minute. Neha, is it visible?
Yes, it is visible now.
Okay. So here we see the advisory coming from NSE 15th March. Please read it very carefully because that is a commonly found error where companies are presenting investors presentation along with the audited results. So it says manner of filing financial results, right? As required in regulation 33 of SEBI LODR regulations. Dear sir, this has reference to outcome of board meeting held to consider and approve financial results filed by companies under regulation 33 of SEBI. This is to bring to your notice that exchange has observed. I can't name, but there are top 3-5 companies also in terms of market capitalization who are doing this mistake. This is to bring to your notice that exchange has observed that few companies includes shareholders letters, investor presentations in the outcome of board meeting held to consider and approve financial results in which financial results, audited report, etc. as required under the aforementioned regulation were included much after the said letter and presentation. So now what NSE has given an advisory that listed entities are requested to note that PDF of outcome of board meeting held to consider and approve financial results must include financial results. So what comes under the part of quarterly results is the financial result, the auditor report and other statements which are prescribed under regulation 33. If you have to disclose any other information or an investor presentation or any shareholders letter, that needs to be done separately. So that is the point one. So this is a mandatory advisory which comes from NSE. I hope there is no confusion regarding this because majority of the companies are uploading uploading the same in consolidated manner. Also, there is a lot of confusion regarding whether we are required to upload the investor presentations or not, because maximum companies upload their financial results and unaudited results, but you will see 30, 40, 50% of the companies not uploading their investor presentations. So we researched through the entire topic. We went through the guidelines of exactly how LODR prescribes us to give investor presentation. I would say to benchmark, Asian Paints is a fantastic company to benchmark an investor presentation. One, two, there is a change in an era wherein in last 10 years, a company only used to have a AGM, used to communicate with their stakeholders once a year in a very straightforward annual report without any visual aid or something like that. And when you see that entire annual report, it was majorly presentation of financial statements only in the AGM. Now times have changed. Companies feel that they should move ahead. They should quarterly communicate with their stakeholders. Asian Paints generally do a quarterly conference kind of a thing in which they give their investor presentation in the quarterly conference and upload it on the website also. My point here is one, when you look into LODR, investor presentations are mandatory. Point number one. If there is a significant event which LODR itself have defined, which if we get some time, I will run you through that guideline. But all those events signifies one thing to me, that in 80-90% of the circumstances, such events are generally happening between quarters. So it is advisable to give a investor presentation, not only for complying to the LODR guidelines, not only to bring that culture to comply to that LODR guidelines, but also effectively communicating like the way Asian Paints are doing your stakeholders. Now, understand one thing to all those participants who, benchmark uh, the larger companies and think that the larger listed companies might not have done, might be following the best practices. I would say even the larger companies, name it any company, they are also slammed by SEBI on various issues. But what I am trying to say, the larger companies might not require to do lot of communication with their stakeholders because they have already win that trust with their stakeholders. That is where I feel it is important that the small and medium companies which are listed on NEC on the small and medium platforms, do these investor presentation to win more trust, to gain more confidence of investors. So please don't benchmark the larger companies. They have already communicated with their stakeholders in various ways, and that is why they have been large in terms of market capitalization. Look into your company's positives and strengths, your requirements of communicating with your stakeholder, looking into your requirements, look into this quarterly results would be my humble suggestion. I hope my screen has changed. Neha?
Yes, sir, it has changed. PPT is back.
Yes, Ankit.
Okay. Okay. So first is the quarterly and annual financial result. Then LODR is on the financial statements also, wherein a non-compliance is observed with a technical standard or a Companies Act, that there also SEBI gets activated. Then the auditor's report, and in majority of the cases, Kuldeep ji, recently we found the case of Cafe Coffee Day also. We found many other cases where SEBI initiated an investigation, NAFRA took it further and imposed heavy penalties on auditors. And these heavy penalties were, and this is not only in case of Cafe Coffee Day, the recent pronouncement, a penalty of 1 crore is there. It is also because of inabilities of auditors sometimes to bring key audit matters in their audit report. My humble request to all the participants who are from the auditor side, I think we have to look into the key audit matters. Your audit report is under the prerogative of LODR also. And in case you fail to disclose the key audit matters in your audit report, then that's a problem. In some cases, I and Kuldeep ji jointly work. Yes, please.
I think you have rightly mentioned about Cafe Coffee Day, but people must be aware of what has happened in Infosys matter also this year.
Right.
If you are aware, the auditor, forgot to annex or upload the right audit report, which was containing the key audit matter. It has also become, I think, a debatable point whether the same can be done through just uploading, providing a rectification letter to the exchange. So I think it is better that if you can throw some light on that also, so people can.
So that is for sure, Kuldeep ji. I think it required a separate uploading of entire rectification should be done through a process of generating a separate UDIN, and issuance of a fresh audit report is what was expected out of it. So
revised audit report.
Revised audit report, right? So that is where I feel that the larger auditors or the larger companies also miss this entire key things. More importantly, I feel that while we look into the key audit matters of the annual report, and we look into the significant notes to accounts and estimates which these companies prepare, there is a limited correlation between the auditor's report and what management feels is significant. And that is where I think majority of the auditors fails. Some auditors, so management feels that this entire, for example, an impairment is significant to them, right? And when or a estimate which they have made in terms of a valuation is significant to them, are you bringing that estimate or that impairment in as a key audit matter in your auditor's report, and how did you address that matter? So materiality again becomes an important part. But what I sense out of it, all the audit reports which I and Kuldeep ji and the research committee has been jointly taking it, is one thing is for sure. What is significant for management is sometimes not significant for auditor. And I don't know how that is happening. That practice needs to change. Then, as I told you, the majority of the cases pertains to LODR, pertains to related party transactions also. And I- uh, in some cases, we have found that companies have adamantly not disclosed their related parties. But in some cases, there is a problem with the checklist which auditor have taken with respect to the related parties and the management which has provided that kind of a checklist. Sometimes it is inevidently, mistaken also. But I would want to add one very important thing here. That is the timing. So Kuldeep ji, when we were looking in the major non-compliances or major notices slammed by SEBI, I realized that 50% of the notices pertains to the timing of the uploading of the entire activity. So my friends, I am just not saying, it's just not about not disclosing a particular thing or non-disclosure of a particular item. Important is the timeliness also. You will realize that certain things, if LODR prescribes you to upload certain things within 7 days, then it needs to be uploaded within 7 days. If it is done after 7 days or after some months, then the problem is that the red flag is raised and then the whistle is blown. When the whistle blows, then probably the whistle is blown for some X reason and you are trapped in some Y reason. So that is why I am saying please give a emphasis on timeliness also while you are doing it. When you look at entire LODR 2015, I think SEBI has always given us how a particular item needs to be disclosed there, including, you have the management discussion and analysis, you have the corporate governance report, you have the segment reporting, you have related party transactions, you have quarterly results. All these requirements SEBI has given through various regulations. If we have time in end, I will brief you through that regulation. But important is that we have to be updated to the regulation. Because like I'll give you one more interesting change what has happened. So we see introduction of integrated reporting in this entire ecosystem. And we see that now top 500 companies are adopting voluntary policies, voluntarily they are integrating their reports. We will discuss integrated reporting in detail. But what has happened because of it, I am again reiterating, your management discussion and analysis portion has been compromised. You do a risk assessment of capital in integrated reporting, and you feel that there is no requirement of mentioning the risk and concerns in management discussion and analysis. No, they are two separate things. Don't have repetitive content. When ICAI presents these kind of awards, I think ICAI looks into one thing for sure, the repetition of content. Lot of companies have started, because of giving more disclosure, they are making their reports bulky. The idea is not to make bulky reports, but the idea is to make a crisp report, a report which can be cross-referenced, a report which can be which is easily, which you can easily navigate. All these things are a strength of an annual report. Don't forget that. If something is coming in integrated reporting, doesn't mean that it is not required to be disclosed in management discussion and analysis. Specifically the corporate overview section. In that entire section, you have to cross-reference it. So make sure that you cross-reference it. While we discuss integrated reporting in detail, we will definitely discuss this aspect also. But I hope what the message I wanted to give out of this is that if your report is an integrated report, then you can't compromise your MDA. And MDA is a statutory function which statutory report which you have to take it as a part of your board report. Since now you must have been concluded with your board reports, you must have realized your corporate governance report, your audited financial statements, your management discussion and analysis, everything is approved in the board meeting itself. Why? because it being a statutory report. So please, I think that is a commonly found error after coming after integrated reporting coming into picture. We realize that the management discussion and analysis portion has been compromised. There's a clear LODR guideline as well as some portion of the Companies Act which is applicable. Yes, Kuldeep ji, please.
As per MDA, I just want to add one thing to what you have said in your deliberation, that as per regulation 34(2)(e) of SEBI LODR regulations, MDA is something which is a statutory compliance or presentation of which is required to be made in the format which is required or mandated by SEBI in the regulation itself. So be it an integrated report, be it a normal annual report as per regulation 34(5), it is something which cannot be compromised. So there are two things which Ankit ji have rightly mentioned, that one is reputation. The reputation should not be there because it makes your report, I think, the users or the readers of the reports disinterested in going through the same. And second is non-compliance of SEBI LODR regulations. So these points seems petty or tiny or small issues, but these issues are bringing in many notices or penalties or fines from the SEBI on various companies itself who are listed on the stock exchanges. So if there is anything which is required as per the statute or as per the SEBI or as per the Companies Act, it is to be complied with in any case, be it what kind of report you are preparing, be it an integrated report, normal report, or thematic annual report. So I think we should not lose in pursuit of preparing a good, visually added, good looking annual report, what the statute requires. So it will be it will be like losing your soul and looking beautiful at your face. So I think it is something which is to be taken care of.
So I think rightly said, and as you said about how SEBI intervenes and issues notice, I had some recent glimpses of or the clips of how SEBI intervened and what happened in a particular case. So one, two or three more commonly found mistakes comes from these headlines itself, right? The first is the non-disclosure of statutory dues, and that is where a very strong action is initiated by regulator. We saw that in year 2014, 15, 15, 16, right? This media company had a 450 crore tax demand outstanding, and SEBI slammed a notice of 2 crore. Once SEBI slammed this notice on the promoters, Kuldeep ji, then we witnessed that SEBI slammed another 3-4 notice on the face of this entire media company. So my point again, I will reiterate that once they get activated, so they were activated by a very small thing. I would say that there was a non-disclosure of a statutory due. So as a checklist, when we do it, we make sure that, we take a management, we not only take a management representation from the auditor side, but we also look into the online portals of CBDT and CBIC or the income tax or the GST and look into any outstanding demands from there. Also, what all are reported in the previous audit periods, you should also check through the previous audit reports, since there might be a case that you might be a newly appointed auditor, a newly joined company. Read the annual reports, look into the existing demands, make sure those existing demands corresponds to what is mentioned in the annual report. Similarly, a commonly found error is where there is a mismatch of the quarterly results and an annual financial statement. And the same happened in case 2 of a beverage company, and directors were, penalized for flouting such norms. So once you get your quarterly results approved, make sure that they correspond to the financial statements. Kuldeep ji, before you add something to this, I would say in 2 or 3 out of 10 reports, where data between the annual reports do not correspond to each other, something which the number which is been given in a chairman's speech does not correspond to the number which is mentioned in the financial statement itself. and that is where I feel we have to highlight such kind of issues. And when we look at the bird's eye view of an annual report, I think we'll be able to justify what we are trying to say. Kuldeep ji, over to you.
I just wanted to add a few things in these two cases which you have mentioned. One is regarding, slapping a fine of rupees 2 crores on this media house. So, as you have rightly said, it was activated, the action was activated for some other purpose. As of now, the situation in this particular case is that it is pending in the Honorable Supreme Court, and the process is still going on. But later on, it followed with 3 to 4 bigger notices or bigger issues, which was there, like, insider trading or non-reporting of pledging of shares. So it opens a Pandora of problems, or it leaves your issues open-ended, or it gives them access to other problems which were not on the face of the financial statement or the reports as of now. And in the second case of this Manpasand Beverages Limited, I guess there was one interesting finding also, that they came out with an IPO, I think 5 to 6 years back, and in that
Right,
particular
right.
year only,
They had these QIB
for that
proceeds.
particular, yes, QIP proceeds of 400 crores, and SEBI has initiated, an investigation related. It is a journal process, like picking up any of, you can say it is a scrutiny of the QIP documents, and they found that they deviated in at 2 places in utilizing the proceeds of the QIP. They've utilized it for some other purpose. So even the management and the companies are required to be aware of the fact that the regulators or the external regulators, everybody is having a watch upon you, and you need to be compliant in all situations, be it utilizing your IPO proceeds, or be it uploading or giving any sensitive information. There is a recent, there are recent changes which are going on the manner and the type in which the sensitive information related to any company's financial statement of the business will be uploaded on the exchange. So things are changing. The time
Right.
has also changed. So it is time to, know, gear up and up our sleeves to be in the race, I should say. Ankit ji, please.
So Kuldeep ji, I just want to add one thing. I think wherever we have been working with all the companies together, we realized one thing is that the internal control system of capturing this information is also very important. When we discuss the in later stages of the presentation, when we will discuss the commonly found errors by NAFRA in financial reporting practices of large listed companies, you will realize one thing. NAFRA gave a recommendation of setting up a control mechanism to capture such kind of information. So sometimes it might happen, like we received a query also on non-funded, how do you disclose a non-funded borrowing? And I'll take it forward because that query was received way before the session itself. But my point is that whether are you able to capture the right information or not is also important out of entire scenario, especially when you are issuing, where there's a matter of collateral, where you are pledging your shares, where sometimes the entry is not routed through books. There is the problem where you have to have a control mechanism to capture such information. So as we witness this, I think there is a lot that have been evolved in last 10 years. And this year, can anybody tell me who got the gold award for excellence in financial reporting in manufacturing sector? So let us analyze their report since last 10 years. That is what I am trying to do, Kuldeep ji. That if we can get an answer, who received the gold award in manufacturing sector in excellence in financial reporting. And I feel their practices were ahead. I feel that when we evaluate this company's practices. They were really ahead of the other companies who were not able to, not able to reach to the finishing line of this award. Any answers, Neha?
No answers yet, sir.
I still doubt whether your chat box is functioning or not. I am curious to know. Ask somebody to at least write hi. Okay. So this year we received this year Dr. Reddy received the award for excellence in financial reporting in gold category. And when you look at the last 10 years annual report of Dr. Reddy, you will realize what kind of changes have come in last 10 years. Before I look into it, I want to mention two very important issues. One, I think when we say excellence in financial reporting, lot of companies who apply for this award or who thinks that their reports are excellent, right? They submit only the financial statements for evaluation by the research committee. So it's a common mistake while you are getting evaluated. You just submit profit and loss account, balance sheet, and the statement and cash flow, and consider that your financial reporting practices are excellent. So there are a lot of cases coming like this. It is eventually about presenting the financial as well as non-financial information in a correct way. So that is point number one. Don't be confused of, when we say financial reporting framework, it is just not about the profit and loss account and balance sheet. The second, the second thing which I want to come up is with the evolution of these annual reports. And when we look into the evolutions, you realize that there have been a lot of changes which are happening. I will again post a question to try to awake you on this entire webinar. What do you think are the top 5 changes you see? I am just talking about 5 changes. Top 5 changes in last 10 years in an annual report. Why I'm putting this point? So that in case, if you are unable to take up to those changes in your annual reports, you can at least start embedding them, especially for the smaller companies which are not governed by, SEBI. Top 5 changes in annual report in last decade. Any answers?
So we have received one answer.
Finally.
This is ESG reporting.
Fantastic. So yes, it is a top answer. Can we have more answers? I really want audience to participate. We will be almost ending up this session in next 30-40 minutes.
No responses yet.
No responses. So the chat box is working. One thing is for sure. Now I again go back to, the last few changes which we are able to see in the annual reports in last 10 years. The first change, I think, is the digitization. And as we were progressing through this entire presentation, I told you one thing, as CFOs, as a part of a corporate reporting team of your entity, please try to do cross-referencing in your annual reports. Majority of the companies, only the large company does this cross-referencing or creates those hyperlinks. I think the first thing is the cross-referencing. The other is the visual aids. And I like what Deep ji has said, just by merely giving visual aid doesn't make your presentation excellent. It is about the quality of the information also which you are expected to provide. But in 10 years, we see the visual aids to the extent, as I was telling you, that a lot of companies have now started giving audio transcripts of their AGMs, right? You will see an era in next 5-10 years. This entire ecosystem of corporate reporting will evolve, and you will see, more visual, more artificial intelligence based annual reports rather than people doing entire things through a very bulky document. Because one challenge which comes in front of us is the length of the report, and that is where I feel that integrating the integrated report and the BRSR report in an annual report makes it much bulkier than the previous reports. The another important change which we see in our annual reports is the interactiveness, and I think there is a constant effort done by the companies, their corporate reporting teams, to interact with their stakeholders in time and again basis. And that is why I told you that putting up an investor presentation is extremely important also. The third is today we see that the reports are based on themes. When you look at each annual report, you sense that there's a theme around it. That theme could be linked to the product of the company or not. I was, Kuldeepji, we were looking at a report of Future generally, and I like they presented it in the very, it might be a disruptive way, but they presented that entire report on a Bollywood theme and Bollywood songs. Now they are just governed by the IRDA regulation. However, just to make it interactive, just to make it interesting, just to make sure that the reader turns the next page, they have tried to do that. Interestingly, they sold 3,900 copies, as told by their CFO himself. They sold 3,900 copies of their annual report on Amazon. So could be a disruptive way, but however, I am not talking about that level of interactivity. I am just talking about the interactivity which is expected, to communicate better with your stakeholders, and interactivity which Asian Paints does by holding a quarterly conference, and interactivity which comes from your investor presentation, and interactivity which should be embedded in your annual report in depicting right things at right place. Again, I would say a commonly found error. Sometimes report contains everything but at wrong places. So you will find, you will find that this is not only flouting with the LODR guidelines, but this is also confusing the investor himself. So make sure when you prepare your annual report, you have a structure in your mind and the content is placed as per structure. The problem is, and that is what we working as a team also witnessed, that as soon as the board meeting gets over, the management starts delivering. Now the accounts are approved, everything is done, the year is closed, no problems, only annual report needs to be prepared, and that is taken on a very lighter note. I would emphasize again on the point that this is an important activity. Once you close your financial year, I think here the process starts of keeping a regular update, or making a regular update to your annual report, and making sure that it sails through, it sails well, rather, as it gets published. So make sure that all these things are taken care. Don't take it as a lighter activity. Again, reiterating, mere presentation of balance sheet and profit and loss account is not annual report. An annual report will have a lot of things which we will, discuss it. But quick changes, yes, we discussed about ESG, TRSR. Important change, the integrated reporting framework. Also, once you adopt an integrated reporting framework, you realize one thing, that then once you voluntarily adopt it, it is not that from next year you can skip. You have to constantly adopt that integrated reporting framework, which we will be discussing in this session. And most importantly, with Ind AS coming is the enhanced disclosure, and that is what we will be again, detailing out. So I would want to brief you through all these changes which we see in decades, and changes which we expect to see in future. And I am sure that Kuldeep ji will add a lot of content when we go ahead discussing all these things. So Kuldeep ji, I was thinking that we start with the bird's eye view of an annual report, as to how do we divide it in sections, and what are the commonly found errors in all these sections. An annual report, we divide it into 5 sections. One is the chairman's report and the director's report, which also includes the integrated reporting here. The other is the management discussion and analysis section. Then you have your finance, corporate governance. then you have your financial disclosure, and finally, if there are some additional disclosures which are expected to be made. So if I have to give a bird's eye view, let's divide it into 5 sections. Even in while institute technically review these reports for award or for any purposes, they also review this on these 5 parameters broadly. When we look at the chairman's and directors report, something which I feel is critical things which a chairman should have is the numbers in absolute terms, not in relative terms. A commonly found mistake here is that certain people give numbers in relative terms only, and we have to give those numbers in absolute terms. The other is the in maximum companies, Kuldeepji, I would say the vision and mission statement of the are missing, or they are not coming as a part of the chairman's report or the director's report. The SEBI itself regulates this, that the 5-year plan needs to come from the chairman's desk, not in quantifiable term, but the vision and approach should be clearly described in the chairman's message. My suggestion to all finance team, this is a tricky thing, because getting a chairman's message passed through or sailed through is always difficult. My point is that there has to be a communication to chairman's desk. You suggest them, what are the regulatory requirements of a chairman's message or a chairman's report. Maximum companies, these requirements are not there. Rather, in some listed companies of medium and small size, I would say, especially Kuldeepji, the Calcutta-based companies, I felt, their chairman's message was entirely missing. So
people, I just want to add one thing, that we have seen many of the companies where such sort of chairman messages are there, that our aim is to be the pioneer or the leading company of the sector. So it is not about putting in or giving any sort of projection about the financials, how your company is going to grow, and how in terms of numbers, but in terms of your vision, in terms of the process, or in terms of the growth plan that you are following. So that the main intention of putting in a chairman's message is that you are communicating with your shareholders. So if they don't come to know that how you are planning to grow your company, how they will grow their wealth while they remain invested in the company, so it is non-compliance of the mandate of SEBI, as well as it is non-compliance of the trust of the investors also, in my
absolutely.
thinking.
So my point here is, I have a suggestion, and that I give it to our clients also, that you come up with what LODR mandates you in a chairman's message or a director's report, and push that through. Push that through your chairman's desk, eventually asking him to actually put into not a standard message, but a message which helps him to communicate to his stakeholders. One. The other point is the management discussion and analysis, and where we felt that as I told you previously also, that there are major sections which are missing. Also, I would add to one point between the chairman's message and the management discussion and analysis, that is about the value added statement. So a lot of times this value added statement is oftenly confused with the value creation process of integrated reporting. A value added statement needs to be separately disclosed. In a value added statement, if you recall, there is an entire pie chart kind of a thing, which discloses your contributions to the equity, your contributions to the national exchequer, your contribution to human resource, your contribution to debt. So there are 6 parameters, and that is where you have to, that value added statement is also found to be missing in a lot of companies. Sometimes they are presented in tabular format, sometimes they are presented in a format which is not acceptable. So it has to clearly distinguish as to how do you present this entire value added statement. Then coming to MDA, I think, yes, Kuldeepji, please. You want to say something? You're mute.
Here is one question from Mr. Mukesh Kumar from Vendit. that if chairman gives the next 5 years plan in its speech, will it not be a forward-looking statement?
So actually, a chairman's report has to be a forward-looking report itself. That is what Kuldeep ji also said, sir. That please make sure that you don't put any numbers or projections, but a vision, mission, and a plan to stay invested into a company. A forward-looking statement is an acceptable statement and is expected also that not only the chairman's report but the entire report has to be a forward-looking report, sir. That is a humble suggestion from our side. I hope your query is solved. Any further queries till now?
No further message is there in the question also.
Okay. So next is the management discussion and analysis. And as I told you, the biggest threat to MD is the introduction of integrated reporting framework itself. But a MDA cannot be compromised. Some commonly found mistakes is one, the segment-wise reporting. And how do you define your operating segments and how do you classify them? Eventually, how do you report the financial performance? Look into, let's start visualizing an annual report. First comes your chairman's message, then comes your corporate overview, wherein, the kind of company you are, you discuss about it. If you're preparing an integrated reporting, then comes the integrated reporting where you will be introducing your capitals, then you will be quantifying these capitals, you will be displaying the value creation process and eventually the output capitals. And then comes the management discussion and analysis. During the integrated report, please bear in mind about the risk associated with these capitals. That also needs to be disclosed. How do you quantify them also needs to be disclosed. The materiality assessment. And I and Kuldeep ji found a very common mistake into materiality assessment where companies are preparing integrated reporting, but they fail to give materiality assessment. Thinking, because in today's era, since it's a voluntary adoption, thinking that they are doing materiality assessment in 3 years or 5 years or 2 years. That is why when they do a materiality assessment, they give it. Our suggestion is, if you are doing a materiality assessment, make sure that you give it. If you're not doing it, then tell the practice how do you do it. If you are doing it over a period of 3 years, please define it. And that entire visual aid of materiality assessment, the the significance of each capital needs to be linked to this. So we will definitely try and discuss an integrated report in this entire process. But let's go back to then we come on the management discussion and analysis. And here I feel that a lot of companies talks about risk management. However, they are still not able to benchmark to the global framework, the framework which came in as an ERM 2017. Also, there
Ankit
was a
ji,
problem.
I would like to put in a question from behalf that the participants please write down in the question answer column that which are the two most prominent risk management frameworks, so that we can make it a little bit more interactive. Before we'll tell you for sure, but just give your opinion on what are the two most prominent risk management frameworks.
Neha, we are expecting some answers.
Yes, sir, definitely.
Do we have any
Meanwhile,
answers?
The participants put in the answers for this question. Mr. Suresh Satish Joshi from Mumbai, Delhi has written that how could it be realistic without putting in figures in the chairman's speech?
Sorry, I did not got the question, Kuldeep.
It is related to the forward-looking message that is
Right.
required to be given in the chairman's speech. So, Mr. Satish Joshi from Delhi is asking that how can it be realistic without putting in figures?
So I am saying, I'll again reiterate it. What is expected? Figures are expected for the current year. I hope that is clear, right? Key figures, maybe your top line, your bottom line, your EBITDA, your expansion plans, right? What the new products, everything needs to be embedded in the chairman report. One, sir. Two, you should talk about the next 3-5 years journey in, you know, relative terms only, not in quantifiable terms that, you know, in 2026-27, we aim to achieve a profit of, say, X amount, or we aim to do a top line of Y amount. That is what I am asking you to refrain to. I am saying 3-5 years business plans. I am not asking you the financial plans, but the operational plans, and why, what good this company is doing in next 3-5 years to enable their investors to be vested in it.
To add on to what you have said, Ankitji, I would like to add one thing, that the reason behind SEBI asking or SEBI mandating not to put in any sort of numbers of these kind, which these type which state that this will be the profit after 5 years, these are price influencing information. So basically, the purpose is that companies should not start putting in numbers which in process lure investor that profit is going to be 3 times 4 times after few years. So it is about putting in your business plan. You can put in the absolute numbers which are there and which are quantifiable, but you cannot give any projection which indeed will influence your stock prices. So basically the purpose behind not putting in this type of information is this only. Second question is from Mr. Murarikant Agarwal from Seeker, that he is asking, is chairman's speech treated as chairman report?
No, chairman's speech and chairman's desk, chairman report, letter from chairman, sir, नामकरण कुछ भी हो सकता है, कोई इशू नहीं है, इस पे कोई गाइडलाइन नहीं है कि chairman speech कैसे लिखी जाए, but chairman's report, chairman's speech needs to be there. That is something which is important. Sometimes companies gives their MD's report having a executive chairman on their board. That kind of an error is also being observed. That is the only concern, sir. Do we have any answers?
Yes, Saloni Jain from Delhi and Dheeraj Debraj Gupta from Kolkata has mentioned
Kuldeep ji, I am unable to hear you.
Yeah.
Neha, Kuldeep ji is audible to you?
Sir, Kuldeep sir wanted to say that we have Saloni Jain and Debraj Gupta from Delhi and Kolkata, and they have answered that question. So it is COSO and ERM.
Right. So it is the COSO framework and the ERM framework. That is the right answer. Now, my point here is, while we draft the management discussion and analysis section, a request from my side is that, one, please obtain your existing risk management policies. Point number one. Check whether these policies are benchmarked to the global frameworks, what Saloni and the other person have mentioned, that is the the ERM 2017 or the COSO framework. Third, identify the risk based on the risk which are prescribed. Fourth, tell about your risk mitigation procedures. What is the organization's culture to address and mitigate those risks? Next, how do you categorize those risks? That category, that entire matrix of the entire ERM framework. So all these things are important when you say just giving a 4-line, 5-line risk management policy clearly indicates that the company's lack of sensitivity in doing this entire activity. The next is the corporate governance section, and I would say while you put up this section, there is one thing which I and the entire teams find is the director's profile. So it comes as a part of corporate overview also. It comes on the forefront of the annual report also. Then it comes in corporate governance report also. The point is that the only mandatory thing is that this director's profile should come, rather than having it under corporate view. Please try to have it under the corporate governance report itself, exhibiting the quantum of cumulative experience. Exhibiting the quantum of cumulative experience of all directors. The next thing is which I would say, we have to really, as a good corporate governance practice, we have to really deliberate upon is what happens if, I hope you're aware that we have various meetings in corporate governance. We have audit committees, you have the nomination and the remuneration committee, you have various other committees which are mandated by the corporate governance report. And you find that, there has to be a disclosure of attendance which you have to give in all these reports. If there is a major non-attendance, then companies needs to disclose the reason for such non-attendance by their directors. That is also very important. Company just mentioned that out of 4 meetings, he attended 2, he attended 1. If only 1 or 2 meetings somebody has attended out of 4 or 5 or 6, even the CSR committee, then the reason for non-attendance should be highlighted in the report itself. So this is where, the corporate governance report plays a very vital role. It is a very standard format board report, but I still feel that don't play with this report too much. It's a statutory report, brings a lot of issues. If you really have to play with management discussion and analysis, play with your chairman's desk, play with your integrated report. But I feel that the corporate governance report has to come as per the statute, and if there is any material thing coming up, should be disclosed. Importantly, the forward-looking disclosures in corporate governance report. So while a social security code of 2020 or the impact of the new labor code, how those who are charged with governance are gearing up themselves in with the forward looking laws or the upcoming laws which are coming in the country, a disclosure pertaining to this can be really helpful. The next is the financial disclosure, and one thing which I want to specifically come on financial disclosure. We will come in a detailed way after 10 minutes. But one thing which we found very relevant was that the significant notes to accounts which the management prepares, generally they are the draft language of your Ind AS itself. Now, if you recall, 3 days back only, we received an email from Institute as to the accounting standards which are applicable with effect from 1st April 2023. One, the Ind AS. Other, they're transitioning year on year. And Kuldeep ji, this time also they have come very specifically and very strongly that if a transaction is particularly applicable for you, then only report its Ind AS policy. For example, and if it is not applicable, then there is no logic of doing it. So please don't state as it is Ind AS. Rather, come up with the practices customizing to your business problems, your financial statements. That is what is expected when you comply to the Ind AS. We will deliberate this in detail last 15-20 minutes. But yes, these are certain common problems. With regard to additional disclosure, naturally, the BRSR report and everything, we will come up. But two things which I want to, quickly run through is the emerging trends. So there is a constant need for enhancement in financial reporting. One, because of the increased stakeholder requirement. Your stakeholder expects to interact with you way more, right? I'll give you a commonly found error. I hope you are able to see the credit ratings, how they're disclosed by the company. So most of the companies disclose their credit ratings. But what does law ask? So now we are discussing between a reporting which is at par and a reporting which is excellent. So what is the basic difference? I can give you through this example which you see on this slide, that the law requires you to disclose credit rating along with various facilities. So now if you have to disclose a credit rating, you can just disclose it on a standalone basis. You have to disclose it comparatively with a comparative chart and the value of the facility, value wise, that credit rating should come up. So this is what is the difference between a normal reporting and an excellent reporting. Kuldeep ji.
like we always say that there is a very thin line of difference between how you are reporting. One is reporting at par, reporting below par, and other is excellent financial reporting. And these the practices or the commonly found errors which me and Ankit ji will be deliberating upon in next 15 to 20 minutes will be the points which will take your reporting beyond par. So reporting credit ratings is a statute requirement, but in the present scenario where the trust and the confidence of investors are shaking upon due to one or other issues, due to the various sort of information which is available in the social media, it is important that you keep up with the recent changes, and you put in or you present the information in such a way that it builds the trust of the investors also. Ankit ji, without before you move on to the next section, there is a question from Mr. Mukesh Kumar from Vendit India. He's saying that security is not yet notified. Why impact assessment is required? So I think
Neha, you have to help me in this question. I lost Kuldeep ji's voice.
Am I audible, Ankit ji? Am I
Yeah.
audible now?
Yes, Kuldeep sir, you're audible now.
Mukesh ji is saying that Code of Social Security is not yet notified. Why impact assessment is required? So Mukesh ji, before Ankit ji answers this, I would like to give you the answer of this question. I think you have misunderstood. We are not talking about giving the impact assessment of Social Security code. We are just asking, we are just suggesting that you should give a certain note on this particular section, because it is not notified yet on which companies and how it is to be is going to be applied. But you can put in a note. It shows that your company is prepared for what are the changes which are coming in the future. So it shows that your company changes which are there. Ankit ji, now if you want to add something into
No,
this.
I think fairly. Just that you are showing your proactiveness as a company to fulfill the requirements of future. That's all, sir. That is all is expected. And sometimes when we evaluate these reports, this give you additional points. If you are coming up with a forward-looking disclosure, if you don't disclose it, it is not a non-compliance. I am again repeating it. Right? It is just about embedding such disclosures which give you that kind of an excellence. One more
Ankit ji,
example here. Right.
Sorry to interrupt you. One more
No.
question is there from Mr. Lalit Pantangia from Cuttack, that as a CSA of PSU banks, I was forced over phone to act differently. Still, our PSU reporting is not fair, and as far as corporate loans are concerned, are not allowed to be provided for by RBI or the government. Special reason is it for our CMO relation to government? I think the question is not clear. Neha ji, can you put in a message or reply to?
Sure, sir. The question is not clear here. We'll just ask the member.
Please write this question again, please. Okay, very quickly, because Kuldeep ji, we are running short of time, and I don't want to miss the commonly found error of NAFRA. Last thing which I want to come up here with two important things, right? One is the MSME disclosure, and with the aging schedule, lot of companies misses to give the MSME disclosures. If there are no dues from MSME, please give those disclosures, because when you present the aging as per the Companies Act, you present the aging from 0 to 90 days and further, right? Whereas in case of MSME, that aging is 45 days. In that, you give specific column for MSME also, less than 1 year. But there a note is expected below it stating that there are no MSME dues pending, right? Two important things. Let's look into the emerging trends. And I would request, we can have another separate sessions, because they are entire topics. One, the integrated reporting, and another is the sustainability reporting. Oh, I can just give you an overview of integrated reporting before we go to the financial disclosure side. And integrated reporting, as I told you, was introduced in 2014 by IIRC. We have voluntarily adopted. The 500 listed companies are expected to adopt this integrated reporting. companies like Hindustan Unilever, Vedanta, Reliance. You talk about companies, certain companies even we work for, they are doing integrated reporting. The next is how do we do integrated reporting? Rather putting up into a slide, Kuldeep ji, I want to take 3-4 minutes only on it because I know I have almost taken all your financial disclosure section, but give me 3-4 minutes. It is an important aspect because if it would be better if we can look into one integrated report for 5 minutes, next 5 minutes.
Perfectly fine, but seeing the time, I think after taking this report, it would be better that we, make this session open for the question and answers related to the financial sections, along with sharing the commonly found errors, so that we can make up for the time.
Okay, we'll try. But I would still want to run through 3-4 financial disclosures if you permit me, because that is something where NAFRA has been very cautious about. But let's try.
Perfectly.
I hope my report is visible, and I hope participants are in no hurry. We'll wind this up in another 10-15 minutes.
Sure, it is visible, sir.
Okay, so here we come to the integrated reporting. I have opened the last year annual report of Tata Steels, right? And let's look into how it is, how the integrated reporting is presented.
Ankit,
Sir,
the report is not
folder is
visible.
visible. Report has not opened yet.
Okay. I'll reshare it. Now is it visible?
Yes, it is.
So just a minute.
Meanwhile, Ankit ji comes up with the specific slide. I want to put in a question for the participants. Can anybody tell which was the first Indian company to come up with the integrated annual report? Those who know the answer, please write it in the question and answer box. The first company to come up with the integrated annual report in India.
In meantime, by the time answer comes, right? So this is what integrated did. They have categorized in the process of value creation. As I told you, integrated reporting has 6 important capitals. Tata Steels have tried to introduce these capitals to its shareholders. You look at the first capital, which is the financial capital, where if you look at the quantum of this capital, they have talked about the EBITDA, they have talked about the return on average net worth, they have talked about the EPS, they have talked about the average capital employed. So this is where they have introduced you to a financial capital. This is the number which they are doing. Then they have come with the material issues which they have addressed. As I told you, we have to do a materiality assessment. Is the business growth and long-term profitability. And they have talked about how they manage their financial capital. Right. Now, managing capital inputs and liquidity. So you see, they have mapped their KPIs here. They have mapped the achievement of their financial capital, how they are managing the flow. Similarly, the manufactured capital, intellectual capital, human capital, natural capital, right? And finally, the social and relationship capital. So everywhere you see the materiality coming up. And when you look at the entire value creation process into this, you will realize that, they have been able to embed this value creation process very well through this entire report by benchmarking the KPIs. And you have to, like, for example, if we are talking about intellectual capital, a common mistake which Kuldeep ji we found was that most of the companies were not able to disclose the figures in the input figure. So there are 3 concepts. One, the input which you give to this capital to the value creation process, and 3, the output which you get. So see what is the input which Tata Steel is wanting to communicate, that they have spent 213 crores on their R&D, they have developed 62 products, and there is an improvement saving of 5,463 crores. such figures should come out very strongly, and then the value creation process should come out, and then the output of this entire capital. So I hope it will give you a slight overview since we are running short of time. If you have any questions relating to integrated reporting, you can mail me or Kuldeep. I would ask, we will share our email IDs over the chat box, because it's a as I told you, it's a ocean where you start with certain things and everything is ultimately correlated. But if you have specific questions, you can connect us through LinkedIn or any platform. We will share our email IDs pertaining to integrated or sustainability reporting, and we will be happy to answer those questions. I would straight away come to, some very important aspect, which Kuldeep ji, we will take 10, 15, 20 minutes on these aspects. And then if some questions come on them, I'll be happy to help them. I'll be happy to help our participants in these questions. We will be happy. My point here is, one, with NAFRA coming up, as I told you, there is a FRRB which is formulated with institute. With NAFRA, this board is a parallel board which is called FRQRB, Financial Reporting and Quality Review Board. It is a separate board from our institute one. FRQRB selects certain companies, right? What is the basis of selection? We don't know. And reports that, as to what kind of deficiency it found in financial disclosure of the companies. We have tried to highlight the common deficiencies which we found out of 4 or 5 reports. And such deficiencies are absolutely in non-compliance of Ind AS. When FRQRB issues a report, it issues a report talking about high risk problems in deviation of an Ind AS, a medium risk issue and a low risk issue. We have only taken up with the high risk issues commonly found in lot of companies by NAFRA and with our analysis also. So to begin with, I think the first point pertains to, implementing the provisions of the financial instrument, and which is related to the impairment allowance also. Kuldeep ji, I would want to state the facts of the case first, and then let us have a deliberation. So,
Perfectly fine.
Companies, right? If you look into the notes of accounts of the company, we are discussing in context of the first problem, where there is a material deviation found in Ind AS 109, in which NAFRA observes deficiency in implementing the provisions of Ind AS 109 financial instrument pertaining to impairment loss allowance for some of the financial assets. The first and second point are majorly related. The second point I will read along with this, and then we go on the other part. Talks about the impairment allowance using expected credit loss approach as required by Ind AS 109 in respect of contract assets and other financial assets, such as deposits with banks and other deposits. So to all the participants, I am cautioning you here, lot of companies who feel that their financial instruments are with them. Lot of companies who feel their fixed deposits or the deposits with bank doesn't require a policy on impairment, they're wrong. If a company has a financial or a non-financial asset, there has to be a policy and there has to be a methodology to ascertain the expected credit loss because of the change in credit risk rating, because of the change in CRR. Now, with regard to the first and second point, I am coming on the first point first, where this company, they have shown non-current financial assets flown worth rupees 3,000 lakhs. Sorry, the non-current financial assets, others. So while you categorize the non-current financial assets, you will see you categorize in loan and you have categorized in others. And similarly, the current financial assets is also categorized in loan and current financial assets is categorized in others. So now I am reading what Ind AS 109 says. Ind AS 109 says that the entity shall measure the loss allowance as follows: at an amount equal to 12-month expected credit loss where the credit risk for financial instrument has not significantly increased since initial recognition. So when will you measure the loss allowance? If there is no significant increase, then you will measure it as per 12-month expected credit loss. And if there is a significant increase, then you will measure it as per lifetime expected loss. Now, interestingly, NAFRA observed this, that there is no impairment allowance pertaining to this, right? It is a non-compliance. Why? Because this company had a non-financial asset plus the non-current financial asset plus the current financial asset. Now, company responded to it. Let us hear what company has to say. Company says our non-current financial assets are loans which we have given to employees or the loans to subsidiaries, right? And interestingly, company has quoted that based on their past experience, there is no default. Hence, impairment is not required. अब आप ही बताइए, you guys tell us whether an impairment is required on it or not. So I will reiterate, NAFRA has slammed this company saying that, this cannot be a plea that past May it was recoverable. So there is no impairment, which is required, or an investment is made in the wholly owned subsidiaries and subsidiaries are in fully control. Such kind of pleas doesn't work. They are significant accounting policies. You have to come up with your ECL policy as to how do you disclose it. Kuldeep ji, you had something to say.
One more thing that was there in this particular case, that there is a slight confusion between the those who are preparing the financial statement, whether at what price, at what amount the trade receivable should be recognized in the books of accounts. So it is
Correct.
It should be recognized at transaction price, not at fair value. And it is clearly stated in the para 5.1.3 of Ind AS 109 that the initial recognition of trade receivables should be at the transaction price. So I think this was one issue which was.
And this is the same advisory of 29th March, where trade receivable, if they are a part of substantially you are financed by your trade receivables, then how do you measure it? And if not, then how do you measure it? And a lot of companies were mentioning it at fair value, but they have to mention it at the transaction price. Very well said. Also, while this, going ahead, so all these companies having deposits with banks or the financial assets, right? They are expected to use the ECL, expected credit loss approach, and just merely saying that the deposits are with banks and they are in consortium, they are consortium banks of SBI or a nationalized bank, doesn't pose you a threat. NAFRA has clearly said that the expected credit loss, even in case of bank deposits, needs to be clearly mentioned, and the impairment allowance needs to be given on such things. So these are this point. Right.
I think the focus. The focus in this particular point is that they are not mandating the company to disclose or present an expected credit loss if it is not there.
Right.
If they are saying that it can be a bank, and hence there cannot be any ECL. So the process of evaluating whether there is a ECL or not should be there and clearly documented. That is what the
absolutely. Again, the focus was on. Again, the focus was on how do you capture this? What kind of controls you have to calculate this ECL? So well said. So the next point pertains to the third point, pertains to lot of companies, as I told you in the beginning, also have related party transactions and they have not disclosed in requirements of the Companies Act 186 subsection 4, right? So here you see that there were loans related to, related party loans. Company has disclosed related party loans, but company failed to disclose and also have disclosed the interest and repayment terms and certain things, but failed to disclose the loan tenure, the collaterals. Please go back to the 186 subsection 4 and look into what kind of disclosures are mandatorily required. So please bear in mind the rate of interest, the repayment terms, the due date, collaterals, everything needs to be specifically disclosed for in compliance to the Companies Act. I
And
hope that is clear.
I think if I am not overstating, you will find it in I think almost 2/3 of the companies that this particular disclosure in this way is missing. So though in this case, I think on this particular point, NAFRA has not imposed any sort of penalty, but they want the company to be compliant or accurate with the disclosure. So this is a common problem which is we have seen in almost 2/3 of the companies.
Correct. Next, next is the non-disclosure of general terms of payment. Again, similar problems, Kuldeep ji. People disclose their aging, but you have to disclose the significant payment terms, right? Also disclose whether these trade receivables are your significant financing components or not. Even if they are not your significant financing component, then also you need an enhanced disclosure on that front, that why do you consider it as to they are non-significant financing component. Since we are running short of time, I will very quickly take you to the disaggregated revenue under Ind AS 1115, and lot of companies fail to disclose. I will tell you, companies till in 115, lot of companies fail to give this entire note itself. Problem number one, where how this disaggregated revenue is coming. Now this disaggregated revenue is based on the type of goods or service, the geographical region, the market, type of customer. This company had both government and non-government customers, so that is how the bifurcation is expected, right? The type of contract, whether it is a fixed price contract, most importantly, the timing of transfer of goods and service, right? The contract duration, the sales channel. So this entire revenue needs to be bifurcated into it. If any of the component is missing and where the company is operating into is a major non-compliance which we see. The next is about the leasing arrangement, and there I think companies fail to disclose as per lesser and as per lessee. Problem number one. As per lessee, they fail to disclose whether they are short-term lease or long-term lease. As far as from lessor's point of view, they fail to disclose as the lease is a short-term, long-term. They fail to disclose the nature of transaction of this lease. And if you have a rental income or you have a rental expense, how do you disclose it? Companies are not able to properly disclose their right to use. All these things, I think we have to go back to Ind AS 116. Almost it has an applicability of all kind of entities. Kuldeep ji, please.
I would like to add a few things in the previous slide that you talking about, aging part or the financing part of any transaction price. That is a clear-cut non-compliance of para 63 of Ind AS 115, which requires you to state the particular information which is required to be reported. And there is a surprising thing which you have found about aging, Ankit ji, in many of the companies, that it is clearly mentioned in the amended Schedule 3 as well as the guidance note of the institute that the amount of trade receivables or payables which are there on the face of the balance sheet should correlate with the amount which is there in the aging schedule attached enclosed along with the note. And many of the companies are not giving the total aging, understanding that the amount which is not yet billed or not due is not required to be reported. So it is one of the common mistakes that we have found while going through the financial statement of the companies in respect of the Ind AS 116 leases, there are two sort of information or methodology which is required to be reported. One is the company as a lessor and one the company as a lessee. So in many of the cases, the company has rightly reported the policy as when the company is acting as a lessee, but the company has failed to, report it properly where the company is acting as a lessor. So
Correct.
this is something which we have commonly found. One thing which I would like to add besides this particular slide, that there is an Ind AS 107 which requires, the para 40 requires you to present the various type of risk and the sensitivity analysis of the particular risk. So we have seen, Ankit, that in many companies, like market risk you need to report and the sensitivity analysis is required to be given. Companies are giving or disclosing the risks which are not applicable related to the companies. Say if there is market risk, you can put in price risk, you can put in commodity risk. If the risk, a particular risk or the type of risk is not associated or not applicable in your company, you are not required to give the same. And the sensitivity analysis, in all cases, the type of risk that you are identifying is required to be given for all type of market risk as per Ind AS 107. Ankit, please.
So rightly said, we had the other price risk, we had the credit risk, we have the foreign exchange risk, right? Interest rate risk, sorry, right? And a lot of companies fail to give the sensitivity and fail to understand the definitions of these risks itself. So very well deliberated, Kuldeep. I think you covered almost everything, from end to end. The last point, which before, the other points, maybe we can discuss it in the later sessions, because we have a series of webinars and we'll try to present fresh content every time when we come up with. But is that a commonly found error where company has not disclosed whether its owner and others have the power to amend the financial statements. While NAFRA posed this question to a lot of companies, they think that Companies Act mandates, Companies Act clearly defines. The Ind AS 10 clearly says, I am reading as it is, that an entity shall disclose the date when the financial statements were approved for issue and who gave the approval. If the entity's owners or other have the power to amend the financial statement after issue, an entity shall disclose the fact. My point is, if they have that power, companies are disclosing it. Generally, people don't deliberate on it. Even if company don't give such kind of powers, then also an additional disclosure is required, right? So there are certain other points, but I think primarily we have tried to sensitize you to all the major issues which we come across in manufacturing sectors. There might be few points which might be left out. I have put my email and Kuldeep's email in chat box. Kuldeep ji, you also put your phone number in the chat box itself, and we would be happy to hear your problems. We have a team constantly working in Jaipur. Also, the research committee is also constantly working in the annual reports. But one thing I feel that, it is a very turbulent time for the entire profession. I'll reiterate it, which side of table you are, be it on the auditor side, be it on the CFOs or corporate reporting time. I think majority of the mistakes when we look into from FRRB point of view, from FRQRB point of view, from QRB point of view, from peer review point of view, pertains to lack of awareness and lack of upgradation. And that is where I think the thrust was, that is where why this webinar was entirely, the series was launched. Can we uplift? I was with, with President ICI last week at Ahmedabad, and he told me, Aniket Talati ji, he told me a very brilliant fact that in terms of quality of audit and quality of reporting, India stands out to be in top 3, 4, 5 countries. Still stand out to be in top 3, 4, 5 countries. It is the audit documentation from auditor's point of view where we do not stand out, or it might be in certain cases the inadequate or inappropriate disclosures which which makes it a problem. So my request will be, with this joint effort, we both have tried that the practices have to be enhanced. The financial reporting practices needs to be enhanced. A thrust needs to be given on the disclosure. Lot of emphasis we should try and do it, in improving the non-financial part. Please inculcate the forward-looking practices. Let us come up with an integrated reporting. Why not adopt the BRSR with its own spirit? That is the future. Sustainability will rule everything, right? And that's how that's what my closing remarks are. Please stay connected. You can have all your queries to Neha and Kuldeep. My sincere thanks to, before I give this to Kuldeep, right? My sincere thanks to the entire research committee for, they have worked very hard for hosting this kind of series, especially Neha, Saloni, Amit ji, and our research committee chairman, CA Dr. Anuj Goel, who have been, instrumental in making this happen. Over to you, Kuldeep ji. Thank you so much. Hope you have any queries. I'll try and write an email to you because I have I have to log off since I have a meeting. Kuldeep ji, over to you.
I would like to thank, first of all, the research committee, the whole team, Neha ji, you, and our dynamic secretary, Amit sir, Chairman Anuj sir, and the whole team that you have organized this in such a excellent way. The communication, the coordination, and the participation is, I think, above par. So I think Ankit ji have covered almost everything, and we are sorry that if we have missed on some part related to financial disclosure, because this is an ocean, and you will require endless time, and we can deliberate till midnight also if you want to continue. So it will be better that if you have any specific query, you can share it through email to the research committee or our email IDs, which will be provided to you by the committee itself. And secondly, many of you will be having this question in your mind that in previous or in past, the commonly found errors are used to be something different. But our intention or our thought process behind putting in the commonly found errors or the commonly found issues related to NAFRA was that it is something which is going to haunt us in the future. So it is better to prepare ourselves and don't be on your Mahabharata, so that Chakravanshi gets into it. So we should be very well aware with the problems or with the issues that are coming from the end of regulator. So that's why we have covered the errors or the issues which was commonly found by the NAFRA authority. So over to you, Neha ji. If there is any question, we can take in next 5 minutes, else we'll write it on the email itself.
Sir, I think most of the questions we have already answered during the session. So I don't find any other questions. So I would like to finally thank all the participants here for taking out the time and helping us for making this webinar session a great success. And I would also like to mention that the next session of this series is scheduled on 12th May, which will specifically relate to service sector. So if anything else from your side, otherwise we can, I think, conclude this.
Just last thing, I think it's important that, I don't know whether our numbers and everything reach to them or not, Neha. I'm very confused because we missed some critical aspects. That is why the emphasis is again on it, right? And we have Dr. Anuj Goel also on the screen itself, right? Do we have Anuj sir?
Anuj sir is here definitely, but actually he's traveling. So I think there is some connectivity issue as well.
Okay. Because we will be glad in case we can have closing remarks from his side.
Definitely. But sir, I think there is some, networking issue from Anuj sir's side.
Okay. So I think perfectly we can close down. Let's stay connected through LinkedIn and let's keep on sharing the relevant information. Thank you.
Thank you everyone for the participation.
Thank you, Ankit ji.
Bye.
Recording stopped.